Good morning, and thank you so much for being here this morning. This is really exciting. As I said, a standing room only crowd. I'm really excited, and it's so wonderful to be here and play a part in the 100th anniversary of the Kansas Association of Realtors. Yeah, come on up, please. Come on up. There's chairs around here, so please make yourself comfortable and happy. This is I should know the number here. I think it is around the 20th year that I've done this housing forecast, maybe the 19th year. And this year, every year I start working with my graphic designers, which I just absolutely love them. We work so well together, and they make all of these beautiful publications that we have. And we begin discussing a theme, and I always like to have a theme, something that reflects the market, something interesting and visually appealing, so they come and ask, so what do you think the forecast will be? What's going on in the housing market? And I just said off the cuff, I said that it's out of this world. And I go, that's the theme. And so we said, they came up with all of these images, from NASA, the images that are available, and so it really, I think, captures the notion of what we see going on in housing markets across the state, particularly, across the country as well, but Kansas in particular has been really remarkable. We need to give big thanks to the sponsors of the forecast publications, but especially Security First Title. Craig, I thought I saw you here. Bernsey, are you still here? I was thinking last night when I saw Craig there and all the support that he gives realtor organizations all over the state, and I remember he took a chance on this concept when we first started doing the housing forecast, and said, yeah, we'd be happy to do that, and went from what was just a digital publication then to have the printed copies that are available to distribute. And then when we were asked by the Kansas Association to expand beyond Wichita and look at other markets, Craig again stepped up and said we'd be willing to help support that. We have other sponsors as well that have been fantastic. Meritrust Home Loans has been sponsoring us in Wichita for a long time, and in other markets across the state, CapFed in Topeka, and Fidelity in Kansas City. So we're very grateful for them, but I really want to give a huge thanks to the folks at Security First. I really appreciate the way they do business and the way they support everybody. And then I have to give a huge thanks to the Kansas Association of Realtors and all of your local realtor boards. It's been such a delight to work with all of you. And the partnership that we've had really matches my vision about higher education in the state of Kansas and everywhere, is that we should be a public good, a resource that is available. And we shouldn't be in the business of competing with private sector providers. And when I came to Wichita and I looked at, where is a place that we could offer some service and provide some value in the market, there were a couple of real estate firms in Wichita area that were doing really nice work in terms of an annual commercial forecast, but nobody was doing anything to really look forward in the residential market. And so I said, well, that's a place where we can add value. And again, now that we do it across the state, it's something that I'm really grateful, and we couldn't do it without the partnership that we have with you and without the contract that we have with the Kansas Association of Realtors, which allows us to access all of your MLS data and then prepare your monthly statistical reports. And some of you may have seen the monthly statistical reports that we sent out just got a brand new refresh. And so starting this month, I think you'll find them much easier to read, very attractive, and they're also personally branded to your local boards. So we're excited about those changes. Well, you all know what's been going on in the housing market, and you know that when I begin my forecast, I always start with the foundation of what's happening in the labor market and what's happening in the mortgage market, because those are the two foundational elements that really drive what will happen in the mortgage market, in the housing markets across the state. And obviously this last year, the word that got overused has been unprecedented, and we had unemployment rates that just skyrocketed in the wake of the pandemic. In In March of last year, the Kansas unemployment rate was 3.2%. In April, it was 12.6%. It just skyrocketed overnight. We've come back down now where we're almost as low as we were, 3.8%. I will tell you that that's mixed across the state. Some markets are doing better than others, and Kansas City in particular, when you look at the labor market indicators, really feels like they've almost completely recovered. Whereas Wichita and some other markets have a little bit further to go to really make up for what's happened with the downturn. And I think a good way to look at this is by looking at the jobs numbers. So the unemployment rate focuses on households, and they survey people and they ask, do you have a job? Are you looking for a job? Do you have a job? Do you have a job? The labor numbers, the jobs numbers, don't look at households, they look at businesses. And they ask businesses, how many people are on your payrolls this week? How many are on your payrolls this week? And so this number here, I've taken and I said, let's start with January 2020, before the pandemic began. What was the level of employment in the state of Kansas and the United States as a whole at that time? And then you can see, well, it bounces around with a little seasonal movement in January and February and March. In April, we dropped down, and the United States as a whole lost about 14.5% of its jobs over the course of that month. Biggest job loss that we've had in any downturn in post-World War II era. In Kansas, it was about 12% of the jobs that we lost. But what I'm really interested here is to ask, how close have we come to fully recovering? And what you can see over here, these are the August data, are the data, the latest that's available. US and Kansas are at about the same place, and we're just a little more than 3% down from where we were back at the beginning of January. So there's still more to recover, and it's been really, really painful, but I think in many respects, a lot of us have been shocked at how much less pain there's been than we expected. And I think a lot of that is due to the extraordinary economic stimulus measures that the federal government did. It's always ugly when they just start shooting money out of a cannon, but in lots of ways you can complain about it, but I do think it did a lot to mitigate how bad some of the fallout could have been from that. So if you were down at Century 2 right now, you would be seeing Jeremy Hill present his economic forecast for Wichita and for the state of Kansas as a whole, and he let me have an advance peek of it, and I think it's okay for me to show these numbers now. He might not show it for another 30 minutes, so please don't tweet it. His forecast is that we will end this year in the state of Kansas up about 1.2% in jobs compared to where we ended last year in 2020. And notice, 2020, we did a lot of our recovery during 2020. A lot of our recovery happened over the course of that year. While we were down, almost 15% in March, by the end of the year, an average for the year, we were down 4.6% in Kansas compared to where the previous year. He's expecting another 1% gain. In ordinary times, that's pretty solid, stable employment growth for Kansas. But as you can see, that number in 2022, we're still well below where we were back in 2017. And so it takes a long time for us to regain and recover from job downturns that we have in Kansas. It's just the nature of the beast. This is a good opportunity. I have somebody taking a picture of the slide, and that's great. Do it. Do what you want. But also, this presentation is now on our website. If you go to realestate.wichita.edu, on the right, you'll see the latest presentation, and all of the slides are there. So if you want to access things that way, you can access that as well. Again, realestate.wichita.edu. So, slow but steady employment growth is the projection that the WSU Center for Economic Development and Business Research has. So what's going on in mortgage markets? And I was afraid with this purple line might be a little hard to read. It's exact same chart that's in your forecast, except the Mortgage Bankers Association's forecast has been updated in these data. And what you can see is 3% mortgage rates. What kind of bizarre world are we living in, right? And Mortgage Bankers Association is forecasting that the 30-year fixed rate will end the year 2022 at 4% and then go up to 4.3%. Had to look at my cheat sheet there. In 2023. That's their forecast going through the end of next year. Now that might seem from this chart like that looks like a really sharp increase. But if you remember a couple of years ago when we were sitting with rates that were sitting around, upper threes, and I said, the Mortgage Bankers Association has finally given up on forecasting rates to go up this year. It's like every year, rates are going to go up, rates are going to go up, rates are going to go up, and it never did. And they finally gave up. Well, actually, where this level that they're projecting is the same level they've been projecting for about the last 3 years. I take that to mean that they think in the current economic environment, a normal level of interest rates for the 30-year fixed rate mortgage would be the low fours. That seems low to me, but being an economic forecaster is a lesson in humility because you're always going to be wrong. The thing that I think is really going to drive when do mortgage rates go up, two things. When do we see an uptick in inflation, real inflation, and I'll talk about that here in just a moment. But more importantly, when will the Federal Reserve begin pulling back on its holdings of mortgage-backed securities? And so this chart here, it shows the holdings of mortgage-backed securities. Prior to 2008, the Fed never bought mortgage-backed securities and held them in their portfolio. In the wake of the financial crisis, they began purchasing them, and it was stunning. They went up and purchased more than $1 trillion worth of mortgage-backed securities. And that was done to help stabilize housing markets, to help maintain, and stimulate the economy in general, a lot of different things that they're doing with that. That level of holdings actually increased all the way through 2015, where we were up at about $1.75 trillion worth of mortgage-backed securities. Now, when the Fed buys mortgage-backed securities, like any fixed income investment, they're driving up demand, which is driving the rate on these things down. Okay, so basically by buying these mortgage-backed securities, they're helping artificially keep mortgage rates lower than they would be if it was just everyday investors who were buying them. Well, they were beginning the process of tapering out of those mortgage-backed security holdings. But when the pandemic hit, it skyrocketed again, and now we're up around $2.5 trillion of mortgage-backed securities. The Fed keeps discussing about the tapering process, and they are leaning right now more towards the side of being slow and measured with doing that. They are less concerned that the uptick in prices that we have seen here recently is sustained long-term inflation, although they're more concerned now than they were a couple of months ago, okay, about the potential inflation. But the Fed is trying to balance these two pieces. They have a mandate to promote full employment and price stability, okay, which means low inflation. And those two are very likely to come into conflict here if inflation begins to tick up. And so they're trying to navigate how they're going to do that. But as the Fed pulls back on mortgage-backed security holdings, that's when you should see mortgage rates begin to tick up. The other thing that may impact mortgage rates, will impact mortgage rates, is underlying inflation. At the end of the day, as an investor, when you lend $1 to somebody else and they pay it back in the future, you don't care about the dollars that you get back. You care about the stuff you can buy with those dollars. And inflation erodes the purchasing power of that stuff. And so we've all seen the information about the uptick in inflation. The pink line on here is the 1 year change in the consumer price index. So that's the headline inflation number that most of us see. And that is up above 5% right now. The Federal Reserve tends to believe that that is due mostly to transitory factors. We had curtailed demand for a period of time, and then all of a sudden pent-up demand hit the market, and that's going to cause this sort of one-time burst in prices. The supply chain issues that we have, I liken it to a traffic jam. Have you ever been driving along the highway and you get to a place where the cars have all stopped and you expect to see an accident and there's nothing there, right? Why did we just go slow for 3 miles here on I-35? Why did this not continue to move? Sometimes you just get those traffic jams, and that's exactly what can happen in the supply chain. And it takes a long, long time for whatever triggered it, maybe long gone, but it takes a long time for the effects and for traffic to move smoothly. But it is transitory. It will work itself out. It doesn't mean you need to build a new highway just because you have that traffic jam there. So I wanted to get a sense of inflation expectations, because that's what matters to lenders. In setting mortgage rates, it's not what the inflation rate was yesterday, it's what I think it will be over the next 5-10 years, because that 10 years is an expected holding period for those mortgages. That's the inflation rate, the expected inflation that really matters. And so the blue line on here, which I know may be a little bit hard to see, is the Michigan Inflation Survey. So the University of Michigan does a survey of consumers. They call up households and they ask, what do you think the inflation rate is going to be next year? What do you think inflation will be over the coming year? And over a long period of time, that number tends to parallel the consumer price index. Now, when the consumer price index has been extraordinarily low, like it was in the mid-teens, households tend to think inflation's going to be higher than what actual inflation has been. But usually, if inflation's running around 2.5%, that's what surveys say. As you can see, as consumer inflation has gone up, households are expecting inflation to be higher next year. So if I called all of you and I said, what's inflation going to be next year, you probably would have said a number of 4, 5, 6%, something like that. And that's what we're seeing from the Michigan survey. But the survey of households, there's a different way of looking at this. And it's called the 5-year break-even rate. There's actually a 10-year break-even rate and others as well. How many of you have heard of TIPS securities? Treasury Inflation Protected Securities. Anybody? They were developed back in the 1990s. And the way that they work, it's like a regular treasury security. So you buy, say, a 5-year treasury bond, and you receive semi-annual coupon payments on it. With a normal treasury bond, if you bought that and it was a $1,000 par value bond, when it matured at the end of 5 years, you'd get back all of your principal. The federal government would pay you the $1,000. With the TIPS securities, every single year they go in and they say, what was inflation this past 12 months? And then if the inflation over the past 12 months was 5%, then they'll take that bond and they will add 5% to the principal value. And so that $1,000 bond now has a $1,050 par value, which that becomes the value on which interest is calculated in the next year. And all through the future, you are protected against actual inflation by changes in that face value of the bond. One of the reasons they began issuing this was to try and get a sense of expected inflation. And what we can do is we can look at what is the interest rate on a traditional 5-year treasury security and the interest rate on this inflation-protected security. And we can do a calculation that allows us to back out what do financial markets believe average inflation rate will be over the next 5 years. And that's what this 5-year break-even rate is. I liken it to looking at the Vegas line. Okay, so we may all be 100% certain that the Chiefs are going to beat Buffalo by 21 points this weekend, right? We're absolutely certain. When you go and you look at the Vegas line, what is it? About 3 points is the Vegas line. What drives the Vegas line? It's everybody who's actually betting on the game, right? They set that line to even out the money on either side of the bet. People are putting their money where their mouth is. They've got something at risk. That's what's happening here. And what story does this tell us about inflation? Well, it's certainly come up from where we were around, when the pandemic hit, and certainly higher than we've been in this 1% to 2% range over the late teens, but it's still only about 2.5% right now. Financial markets, the investors who are putting their money into these securities, by the way they are trading, they are saying they expect average inflation over the next 5 years to be 2.5%. This is one of the things that the Federal Reserve is looking at to try and say, do we think this is transitory or is it beginning to embed itself in the economy? Does that make sense? So if you see this 5-year break-even rate start to go up, that would especially concern me about that building in an additional inflation premium into mortgage rates. Let me pause here and ask if there are any questions about any of that.
I have a brief question.
Yeah.
One of your sources is BLS.
BLS, Bureau of Labor Statistics. Okay? And that is for the CPI inflation. They actually do the CPI inflation. Yeah. Yeah. Good question. Back in the back.
Feel that 2.5% is just a little bit cautious, a little bit understated.
Mm-hmm. Are you asking if I think that or you think that?
You think that.
I learned a long time ago not to bet against financial markets. Every time I think that I know better than the market, I am proven wrong. And that doesn't mean that the market is right at all. But it essentially reflects the collective wisdom, the collective expectations of all of the market participants. Some of them think it'll be higher, some of them think it'll be lower, and they trade based on those expectations. Boy, markets are pretty effective at teasing out that information. So if I had to guess, I'd say this is my best expectation over the next 5 years. Again, doesn't mean they're right. The Vegas line, Chiefs still could win by 21 points, right? The Vegas line may be totally off, but if you're going to bet against it, on average, you're not going to win. So, all right. So you didn't come here to get an economics lesson. You came here to hear about housing markets. If I summarized what I thought about the underlying economic environment, pretty favorable. I mean, we're returning to solid, stable labor market growth, and I don't see a substantial tick up in inflation. To me, 4.5% is still in the range of, at 4.5%, we're at the lowest end of what I think a normal mortgage rate could be. And Mortgage Bankers Association isn't forecasting that for the next couple of years. So what's been happening in home sales activity? You all know this as well as I do. These are the monthly sales of all of the multiple listing services across the state of Kansas. And the pink line is the moving average. And what I want to really highlight on this is where you can kind of see this trend. We had some increases that were going from 2011, 2013, flattened out for about a year, kind of slow, steady increase. And then over the last couple of years, we plateaued. And if you remember my forecast last year and the prior year, I said we're running into supply constraints, that there just aren't enough homes available for sale. Demand is very strong, but we can't seem to increase the number of homes sold if we don't add more inventory. And so whenever I say that, I thought sales would drop just a little bit this year. You all decide dead set. I'm going to prove you wrong, Dr. L. And so here we go. You just took off. Where are you finding these homes to sell?
We're selling our own.
You're selling your own homes. Yeah, it's been really remarkable the way that the sales activity has picked up. And so our forecast for this year is for continued pretty solid growth. What we think we'll end the year this year up about 3.1% across the state, and another 6% increase next year. So I don't know how you're doing it, but you keep finding the homes to sell. One thing that I do think helps all of this is that, and I'll talk about that in a moment, new home construction has begun to really start to pick up across much of the state, and that should help ease the inventory problems. But inventory problems we have. And when I've talked with different people, and especially when newspaper reporters and others call me, I've really tried to emphasize, this has nothing to do with the pandemic. Our inventory problems, we have not, if we use the traditional rule of thumb for a balanced market of a 4 to 6 month supply of homes available, we haven't had a balanced market since 2015 in the state of Kansas. And every year it just keeps getting tighter and tighter and tighter. And now where we're sitting with about a month's supply, and in some price ranges, in some attractive areas, it really is more reasonable to talk about days supply than it is months supply, because it's just incredibly tight. You will notice on here you have that little, this was the pandemic blip, the shutdown blip nationwide that saw that. That was because a lot of places, real estate wasn't deemed an essential activity, and they required realtors to shut down as well, which I just thought was absolutely the most stupid thing I could ever imagine. Whenever you're thinking about something like a shutdown, you have to balance risks and consequences. You are not this is the highest risk thing that you do in terms of spreading the pandemic, right? Being here together at a conference. One-on-one with clients and doing things is not going to create big hotspots. But moreover, if you're in an economic situation where you need to sell, my job has been lost, I've had something that I've happened and I need to sell, you need the services. So kudos to KAR, to all of you for helping convince the governor to make sure that real estate was not shut down in the midst of all of that. But of course, then that just meant you took advantage of it and you just really sold last year. We have seen a slight uptick in supply here the last couple of months. Some of that is seasonal. Some of that is normal, seasonal. We didn't really see the seasonal effect last year, but this year we're seeing that seasonal effect. But I get the sense even from the rest of, from anecdotal conversations when I went around and did my roundtable discussions, that you actually feel like it's cooled off a little bit, even accounting for normal seasonal patterns. But once again, here's the thing that I've been saying is that any other year, if you just had a kind of typical spring, you'd be saying this was the most tight inventory and supplies were really tight. It's just because it's eased a little bit doesn't mean that it's still at historically low levels of supply and creating issues. And it's taken us, 7-8 years longer to get into this. It's going to take us a long time to work our way back out of it. That's the point that I want to make. What I found really most striking here, so this is a breakdown by price ranges, and I think this chart is directly in the presentation as well. I segment different markets. I pick an arbitrary point. You can argue what's the right price point for an entry-level home, for a low-mid, for an upper-mid, for a high-level home. In this case, I set the upper end at $500,000 for the state of Kansas as a whole. Every market that I do this in, this year, where it used to be the case that, the upper end of the market is really flush. Yes, it's really tight in the popular price ranges, but at the top of the market, it's more flush. You really have to be aware of where you are. Over the last 2 years, we've gotten down to a place where the upper end of the market is tight as well. And so that's created a really interesting new dynamic. Now again, one thing I try and emphasize when I talk with consumers, when I talk with reporters and others, is that averages mask a lot of variation in individual circumstances. And so just because the average home over $500,000 in Kansas is really tight inventory doesn't mean that yours is necessarily going to sell really fast. And so That's where I tell people they need to be working with all of you to figure that out. Well, if you've got inventories that are this tight, it means that you have to have rapid home price appreciation. Last year, 6.6% for the state of Kansas. That might not be an extraordinary year in Kansas City. That's an extraordinary year for Kansas. This year, wow. We're actually through the second quarter, and I lost my cheat sheet somewhere, so I don't have my number on where. Maybe I wrote it down on here. Nope, I didn't write it down on my thing. I put down my cheat sheet somewhere. Through the second quarter of this year, home prices are up 12%. Again, don't quote me on that number. I don't remember off the top of my head, but it's about 12% through the second quarter of 2021 in Kansas. We think that's going to slow down a little bit by the end of the year, but wow, 10.5% is really fast appreciation for the state of Kansas. Our forecast of 7.6% for next year, while that's a little bit slower, it's still really, really, really strong appreciation. And again, when you have these kind of tight inventories, that has to happen in order to be able to clear the market. So the thing that I see long term that's going to help make a difference has been the uptick in new home construction. For a lot of years, as we were winding down the inventories, new home construction was really flat across much of the state. It just was not increasing very much. Part of the problem was that in the wake of the pandemic, home prices in many of our markets declined or were basically flat for a number of years, but the cost of construction kept rising. So the value proposition between buying a new home versus an existing home got farther and farther apart. Well, as we're finally seeing existing home prices increase, that I think is helping make it a little bit easier for more people to say, okay, let's make that jump and do a new home. Yeah, I'm gonna spend a little bit more money, but I get what I want. And given that I can't find what I want in the existing home, or I can't win the bidding war, I'm just gonna go ahead and build. And that has been, that long term, that's what we need in order to really help build that up. 35.7% increase in new home construction, and that's not just Kansas City. Sometimes Kansas City swamps everything else, especially with new home construction. That's not just Kansas City. Yeah.
Are your percentages there year over year?
Year over year change.
Okay.
Yep. The percentages are year over year change, and the number above is the total number of permits, and this is single family permits that's reported by the U.S. Census Bureau. Okay. We think that's going to continue next year, another 12.5% increase, strong increases. The markets where we see new home construction being limited isn't because of demand, it's generally due to supply constraints. It seems to be that there's a lack of available supply of land that's in the right place and situated right for development, and labor issues become a real constraint in some markets. So that's a real positive. So our overall forecast, I think I've gone through all of the numbers that we have on these, and this is in the forecast summary page on the back of the publications. I'll just mention here briefly the local markets that we have. Again, I'll mention the anomalies, if I will. Lawrence and Topeka are showing a little bit less home sales growth, and that is not due to lack of effort on everybody's part, lack of desire. It's really just the supply constraints, I think, are more binding. And you'll notice that those are also markets where the permitting activity has been a little bit more limited, although Topeka has really picked up here over the past year and is looking to be much stronger. So with that, I'll ask if you have any questions. Oh my goodness. So that took more time than I meant to. Go ahead.
Stan, one of the things we talked about in our focus group in Kansas City is the inventory shortage. Really may be somewhat skewed based on the behaviors within our market right now. And that is, we've got stuff going straight to pending. We've got things that aren't being counted that would have had more time for research. So if you looked at how that is kind of skewing the research, because I think you're getting artificially low
Well, I think it's really capturing the same idea. So sales. So what he basically said is we're seeing inventories aren't really recovering because sales are happening essentially before they're even put on the market. Which is all right. So it has a days on market of 1 day, right?
0 days if it goes straight to.
And that too is a reflection of the tightness in the market. I've always been an advocate of using a realtor for selling your home because there's just so much that can go wrong that most of us don't know. But I've always said, well, buying, okay, yeah, go ahead if you've got a good relationship and things. But now I tell people, you're going to buy, you better work with a realtor or you're not going to find the homes because you're going to be too late. But that I think in some respects, yes, that's causing the inventory numbers to be low, but that's just the inventory numbers are a reflection of that tightness in the market. It's not that people are doing it just for convenience. They're doing it because the demand is so strong. They've got to be able to. The buyers are trying to make sure. Hey, if I've got a buyer who wants this, I don't want to put them in a bidding war situation or whatever's happening. They want to make sure that they're getting that happening. So. Yeah.
Wouldn't that be skewing the numbers as far as the sales if it's not getting the opportunity to go on the market?
It should still be showing up as a closing.
Right, but the price, if you're not putting it on the market for other people to see it, you're skewing those numbers potentially for the sale price?
I want to be real careful and say I don't know what's happening in terms of that. Obviously, if it was a situation where it wasn't showing as an open and competitive sale, then that might cause the sale home price appreciation numbers to be even lower than they are. But these are pretty incredible appreciation numbers that we're seeing. So, other questions?
Dan, are you looking at percentage over ask at all? Or no?
Yeah, so in the monthly, the MLS statistics that we present, we do show two numbers on those. One is the sale price as a percent of list, and sale price as a percent of original price. And the last few months, we've been seeing sale price as a percent of original price median, which means that above 100%, which means that half of every home that sells is not just above, usually sale price as a percent of original is quite a bit lower. We're seeing more than half of the homes that are selling above that. And in some price ranges, in some segments, it's even higher than that. So yeah, that's very much there. I try not to get too overwhelmed with the weeds here, but that's another measure. Yeah.
How can we articulate to regular people that just because home prices are going up, it doesn't mean that the prices for everything else are going to go up? Milk and whatever else you need, regular inflation.
Yeah. Well, part of the challenge with that right now is in many cases the prices of those other things are going up, right? Certainly, home prices are not going to be a driving force in inflation in that sense, okay? Home prices are going to be affected by underlying inflation, not a driving force in it. Again, there's lots of complications in the calculations of these indices and the different methodologies that you use. So how do you convince people that somehow they're not, you're causing inflation? That's kind of the perception that you have. The house prices in Topeka are not affecting dairy farms in Wisconsin. So I don't know what else to say about that.
I think they use it as a justification that they think the bottom's going to drop out of the market.
Yeah, so that is a concern, right? So some people have asked, are these home prices unrealistic, and is this going to cause us to have a crash, and that therefore I'm going to be overpaying and then I'm going to be stuck? My answer to that is I would be absolutely, I can't even come up with a word of how stunned I would be if we saw substantial price declines in Kansas markets. And here are two reasons for that. Number one, you can point to the financial crisis, okay, back in 2008 and what followed after that. People have in this mind that housing prices cratered. That's not true for Kansas. Kansas City had a little bit of price declines, but still much smaller than the coastal markets that we were really thinking about. And in most every other market across the state, we didn't really drop. We just flatlined. right? Okay, maybe down 1% one year, up 0.5% the next year, but it was basically flat for a number of years. So worst case scenario for us, just based on the nature, and I can give you a lot of reasons why that's the case here as opposed to coastal markets. Worst case scenario for us, we flatline, and that we have a big appreciation and then it stabilizes and we just stay there for a while. That's not uncommon for this part of the country, not just Kansas, but the whole central US. But the second reason I think that that's just absolutely unrealistic to think of a big drop is that part of what's driving this big home price appreciation, it's not, oh, we've got short inventories. It's that we have not been building homes for so long. And while that happened, construction costs were going up. And so the cost of new homes, I mean, you have to think about if new homes are not a perfect substitute with existing homes, but they compete with one another. And if construction costs have gone up here, that's going to limit how much, the downward pressure on existing home prices, because that's the substitute, that's the replacement cost of that existing house. And so for those two reasons, I just think that's those are solid reasons to say, yes, I know it's a little bit scary when you see prices increasing. You're going to buy this house, you feel like you're buying at the top of the market. I would not be, my advice to everybody, and I hope you don't get mad at me when I give it to people, but I tell people, you should never try and time the housing market, any financial market, right? You should buy if it makes sense for you in your personal life. Or am I financially stable? Do I have a good job and I'm confident about my employment prospects? Am I locationally stable? I'm sorry, if I'm going to move in 2 years, unless somebody's going to pay all my closing costs, I don't think it makes sense for me to buy. I know you all don't want me to say that, but that's the fact. That's it's an expensive process to sell. But if it's my family's gotten bigger, I need more space. I'm working from home, I need more space. I'm downsizing, I need to get something different. Those are great reasons to buy, and if that's your situation, go and buy. Same thing with selling. You shouldn't try and time the market on selling it. You should just say, what is it in terms of meeting my needs? So at that point, then, are we at a peak or a trough or something like that? If I'm going to be holding into it for a while, that's not a big deal. And if I'm not going to be in it for a while, then I would argue maybe you ought to think about whether you should be buying right now. So, other questions? Well, I've taken up more than my fair share of time, and we have another fantastic person here.